Good evening, everyone. I welcome you all on behalf of IPNet, and I request Mr. Rajiv Kumar Agrawal to present his welcome address. Rajiv ji.
Okay, Tina, I think I can take over because I believe there is some technical glitch. I
That's
think,
okay.
friends, very warm welcome to this edition of IPNet. I think we are so grateful. Friends, can I request you yourself because I think there's some echo is coming. Yeah, thank you. So I think this is the continuous effort on the part of IPNet, which is the national network for insolvency professionals in India, to conduct webinar every week. So we are doing it on every Saturday from 4 to 6 p.m. And I think people are now in the habit of joining the IPNet webinars. So I extend a very warm welcome on behalf of Mr. Rajiv Agarwal. Of course, he is the host of the today's because IPNet is divided into 4 regions, and today it was the turn of IPNet East. So on his behalf and on behalf of IPNet, I welcome all of you. I think let's have a great seminar. We have Dr. S.K. Gupta, who is the Managing Director of ICMA RVO. I think he's here with us to share his initial thoughts. And then, of course, we have a lot of learned speakers, to dwell on a very important subject, which is intangibles. Now, valuation of intangibles is something which is extremely critical. So many of the IPs I know have been ignoring intangibles, the brand values and others. I think this is something which is a very thought-provoking topic, and I think we will have a great discussion. So I wish all the best to everyone. Rajivji, you are there. On your behalf, I welcome, but you can also say a few
Yeah.
words.
Yes, sir. It's my pleasure to welcome you all today's webinar on valuation of intangible assets during CIRP and liquidation. We are incredibly fortunate to have a distinguished panel of guests and speakers who will help make this session both insightful and thought-provoking. First, I would like to extend a special welcome to our chief guest, Dr. S.K. Gupta, who is the Managing Director of Registered Valuer Organization of the Institute of Cost Accountants of India. Your presence today truly elevates this event, and we are eager to learn from your vast experience and insights. We are also thrilled to have Mr. Vikas Goel as our esteemed keynote speaker, and then heartfelt thanks goes to Sri Ashish Makija, President of IPNet, whose leadership and vision continue to propel this platform forward. IPNet has quickly evolved with a cornerstone for insolvency professionals across India. It has become much more than a network. It's a vibrant community where professionals came together to exchange knowledge, tackle challenges, and grow in their careers. Here at IPNet, we are committed to meeting at the critical needs of the IP, including continuous learning to expand your expertise, timely, reliable advice on matters related to insolvency and bankruptcy code, a powerful forum to voice concern and find practical, actionable solutions. In response to these needs, IPNet offers several standout features: specialized study groups that engage in ongoing knowledge sharing, webinars and discussion on the latest industry's development, and a dedicated member portal providing easy access to resources that address all our professional needs in one place. For those of you are already part of IPNet, I thank you for your continued support. For anyone who has not yet joined, I encourage you to become a member of this dynamic community. The membership link is available in the chat, and we look forward to having you with us. Once again, I thank you all for being here and contributing to what promises to be an enriching and rewarding session. Thank you. Thank you.
Thank you, Rajiv ji. Thank you. Now I request Mr. Vivek Chirania to introduce our chief guest, Dr. S.K. Gupta, who is a Managing Director of Registered Valuers Organization of the Institute of Cost and Management Accountants of India. Mr. Vivek Chirania, please.
Ma'am, should I first run the intro video?
Yes, sir.
Yeah.
In the fast-evolving world of insolvency and bankruptcy, professionals need more than just knowledge. They need a strong network, continuous support, and a unified voice. As the challenges of the insolvency profession grow, so does the need for a platform where professionals can come together, share their experiences, and find collective solutions. That's why IPNet was formed. Promoted by Transition, IPNet is more than just a network. It's a mission to unite insolvency professionals across India, empowering them with the tools, knowledge, strong leadership, and community support they need to excel. Our purpose is simple: to create a cohesive community of insolvency professionals that stands strong together, advocates for their interests, and drives excellence in every aspect of the profession. At IPNet, we believe in continuous learning and collaboration. Our activities are designed to ensure that every member stays ahead in their field, from specialized study groups that dive deep into critical topics like CIRP, compliances, and many more, to webinars and workshops that bring the latest insights right to your screen. IPNet is your gateway to professional growth. Backed by Transition, a leader in insolvency training and resources, IPNet is committed to promoting the interests of insolvency professionals. Our goal is to ensure that every IP, no matter where they are, has access to the best resources, strong leadership, and a network that truly understands their needs. Join us in this mission to build a stronger, smarter, and more connected community of insolvency professionals. Together, we can overcome challenges, shape the future of the profession, and make a lasting impact. IPNet, National Network for Insolvency Professionals in India.
So I now take this opportunity to introduce Dr. S.K. Gupta. Dr. S.K. Gupta had over 43 years of extensive corporate experience, having held leadership positions in both public and private sector organizations. His expertise spans across key domains, including finance, costing, valuation, internal audit, sustainability, integrated reporting, and company secretarial functions. Currently, Dr. Gupta serves as Managing Director of the Registered Valuers Organization, Institute of Cost Accountants of India, Chief Executive Officer of ICMAI Social Auditors Organization, and Chief Operating Officer of ICMAI International ADR Chamber. His key areas of expertise are mergers and acquisitions, corporate restructuring, anti-dumping duty mechanisms, and corporate governance. Dr. Gupta has chaired and addressed numerous national and international seminars and conferences. A visiting faculty member at leading business schools for over 3 decades, he has trained future leaders and professionals. He is also a prolific writer, having authored over 300 articles and research papers published in renowned national and international journals. As the editor-in-chief for various professional journals, Dr. Gupta contributes significantly to thought leadership in his fields of expertise. Currently, he is guiding 5 PhD scholars and conducting management development programs, both open and in-house, for various organizations. I now request Dr. S.K. Gupta to present his keynote address, sir. Thank you.
Thank you so much. Thank you. I'm sincerely thankful to Makija sir for inviting me to this IPNet webinar. And it's an amazing effort on his part to drive the knowledge across insolvency professionals within India by creating this very, very important forum by way of IPNet. And I got to know today that you're conducting this webinar every Saturday without fail. I mean, that's a great effort, great achievement. And welcome to all the participants also who are joining in this webinar today of IPNet. All of you would tend to agree with me that the world is changing. And the world is changing very, very significantly and rapidly. I am not only talking about last 2.5 years, when the world as a whole had been impacted by COVID-19 pandemic situation, but even otherwise, if you look back 2 or 3 decades, there have been some very, very significant changes which have taken place in this world, which have changed the way we live our lives and also changed the way the businesses function in the marketplace. It's very different. It's a VUCA world out there. The business and economic environment is highly volatile, very, very uncertain, hugely complex, and very ambiguous. And on top of all this, there is always that fear of uncertainty lurking at the back of our mind as to what might happen next quarter, next 6 months, next 1 year down the line in the business. Nobody can really predict in this very, very fluid, complex, and ever-changing business and economic environment. In this highly competitive, very complex, very ambiguous business and economic environment, we have some old gold-plated companies which are still existing, sustaining in a marketplace. But by the way, at the same time, there are many solid brands of the past which are no longer there in the market today. Look at Kodak, look at Nokia, look at Xerox, one-time solid brands, but they just could not sustain and stay in the market. But at the same time, we have large number of companies which are still existing, sustaining in the marketplace, and they are being now competed against by the so-called startups and the new age companies. These companies in a marketplace today, because of ever-changing, evolving market dynamics and business and economic environment, are coming out with some very, very disruptive, innovative business models. To give you a few examples, world's largest travel car company does not own a single car of its own. Look at the business model. That's Uber. World's largest travel lodging company does not own a single hotel property of their own. That's Airbnb, Oyo kind of example. And the world's largest retailer, Amazon, does not own a single brick and mortar store. These are amazingly disruptive business models, which were unheard of till about a few decades back, maybe which were unheard of till about a few years back, but these are the realities of the corporate world in the 21st century. The point is today, doing business is not only about having large resources by way of the tangible assets, the so-called traditional plant and machinery, land and building. What matters and what is the competitive advantage for the businesses in the marketplace today is intangibles. That means stakeholders in a marketplace today are no longer looking at the previous old traditional matrices for tracking and monitoring performance of a company. Profit is important. Profitability is important. But more importantly today, stakeholders are looking at ability of the company to be able to create value, ability of the company to be able to preserve that value, and ability of the company to be able to enhance that value going forward on a sustainable basis. That is what the stakeholders today are looking for. And then thereafter, intangibles in terms of patents, copyrights, intellectual property that the company has, company develops, company generates, play a very, very important role in providing the much needed and much desired competitive edge to a company in the marketplace today. If you want to value a company by only looking at the financial statements, I think you're going to miss the target in the sense that the financial statements capture nothing more than just about almost 25 to 30% of the value of the company. Rest of the value essentially arises and is derived from the intangibles that the company carries. And therefore, there must be a comprehensive framework, a mindset amongst the valuation professionals to be able to decipher the value that is entangled and imbibed in the intangibles owned by the company. Well, Walmart acquired Flipkart. 75% of the value that it paid for acquiring Flipkart was on account of intangibles. It was not coming out of the financial statements by way of the tangible assets. And looking at the importance of intangibles to be valued, IBSC also has come out with a perspective paper. I think they have come out with 3 perspective papers, and one of the perspective papers is titled Getting Tangible About Intangibles. I mean, that's the crux. That you got to look at intangibles also in the same manner, in the same spirit as you tend to look at tangibles in order to look at the valuation of the company in a proper manner. In CIRP, we have 3 asset classes as for the present architecture that we have: land and building, plant and machinery, SFA valuer. All these 3 valuation professionals carry out valuation. End of the day, what is actually happening as of now is we are using and applying sum of the parts approach. I mean, you club all the 3 valuations that you get for the 3 asset classes, and that becomes the fair value which is required to be calculated under IBC, and that's how the value is being calculated. But how are you factoring the intangibles? The resolution applicant who's going to bid for that company, he's not only looking for the past, he's not interested in getting to know what is the valuation of the company as of today. He's more interested in finding out the potential economic value of the company going forward. And that, to the best of my knowledge, can be derived by focusing on the aspect of cash flows, which must be realistically forecasted, and then they must also be discounted by using an appropriate discount rate. And cash flow, when you start looking at the cash flows are determined by the collective contribution of the various resources, assets owned by the company, both tangible and intangible. So don't probably need to value intangibles separately unless there is a specific case of a company looking at selling a brand or things like that. But you are doing a business valuation, everything gets captured in the cash flow that you're looking at. But then the challenge and the problem is, how do you realistically incorporate the value that's generated in the cash flows on account of the intangible assets owned by the company? That's a challenge, of course, but it is not a challenge which is insurmountable. There are people using different techniques and methodologies for working out the valuation of intangibles, and we should also seriously start looking at that, both in the case of liquidation as well as in the case of CIRP. The valuation of intangibles is not as straightforward as in the case of tangibles. So even though the basic approaches remain the same, there are 3 basic approaches that we've got to look at. You have the income approach, you have the cost approach, and you've got to have the market approach. But in order to value an intangible, the 2 or 3 prominent approaches that we use, and you're going to talk about that, I'm sure, in detail through the learned speaker is going to follow me up after my opening remarks. You look at with or without. I mean, what is the advantage, additional cash flow, additional benefit that the company is gaining by virtue of its having ownership of a particular intellectual property? If this property was not there with the company, what would have been amiss? So that's one way of looking at it, with or without kind of thing. And then possibly you can also look at it in terms of relief from royalty. If you were not owning this intellectual property, you would have probably hired it out, or you may be paying some kind of a royalty or some kind of a fee for using that particular intellectual property, and that you save because you now probably own that intangible asset. That's another way of looking at that. And I think the most sophisticated approach that we have in a marketplace today with regard to valuation of intangible assets is the option pricing. I mean, there may be an intangible asset which is yet not valuable from the company's perspective. It is still in the development stage. Could be a software or could be some other development for that matter, but which has potential of generating value for the company going forward. You can apply the option pricing model, which is fairly commonly understood by finance professionals with a view to arriving at the valuation of intangible assets as well. So to understand the importance of intangible assets, it is critical that we should understand the nature of intangible assets, which is quite different from the essential characteristics of a tangible asset. But mind you, valuation is not only about numbers. If someone thinks that he's a great valuation professional, he knows all the tricks of the trade, you just give me the financial statements. I know how to do financial modeling using Art Studio, whatever. I can give you valuation within no time. I think it's not the correct statement to make here. Valuation is not only about numbers. Valuation starts with numbers, but then it's all over building and crafting and weaving a story around those numbers. And you can't build a story only around the numbers that you know, which are appearing in the financial statements of the company. You also got to take into consideration and keep at the back of your perspective the intangibles, which may not show up in your financial statement, but nonetheless have huge value for the business going forward. At the same time, as valuation professionals, we must also clearly make a distinction between value creation ability of the company and valuation. Valuation is the potential economic benefits that a company can expect to generate and derive by using the existing assets of the company. But when you talk about creating value, that's all about looking at the potential of the various resources owned by the company, both tangible and intangible, which are expected to contribute to value creation going forward in the history of the company going forward. At the same time, my final call for all the valuation professionals, including insolvency professionals, because in the IBC framework, the insolvency professionals and registered valuers, they work together in sync, in coordination with each other. Valuations are temporary. They keep going up, going down at the stock market, but values are forever. You must always stick to and focus on your values. We have code of conduct both for IPs as well as for the registered valuers. I think as professionals, it is very important to understand and stick to the code of conduct, not only following the code of conduct in letter and spirit, but to my mind, if I may use that word, you must live the code of conduct. Living the code of conduct is the essence with a view to becoming a true professional, whether you are in the IP domain or RB domain or any other professional domain for that matter. With these few opening remarks, I would like to conclude, not stand between you and the learned speakers. I'm going to dwell upon the topic in detail and take you through the critical aspects of valuation of intangible assets. I once again thank Makija sir for inviting me, giving me an opportunity of sharing my brief perspective on valuation of intangible assets. Thank you so much, sir.
Sir, before you go, I think there are a few questions in the chat box.
Yes,
Are you willing to take a few questions, sir?
Sure, sir.
Okay. Well, one, Mr. B.V. Ramesh, I'll read out that question. Dr. Gupta, should the IBBI not be considering a separate class of professionals for valuing intangibles and introduce a separate examination unless it can be easily incorporated in securities or financial assets?
Not only intangible assets, because I'm privy to that discussion, because I've been part of IP also earlier and now RB in close connect with IBBI. They are considering addition of a few new asset classes, not only intangible assets, but they are also looking at addition of few new asset classes. I will not be able to give more information on this as of now, but they're definitely looking at that in that perspective.
Right. I think that news itself, you see, is
Yes.
important that something else is coming up. Some new
Yes.
areas are also coming up for professionals. I think that's a great news. Mr. B.V. Ramesh, do you have any follow-up question or any of my friends who has got a question here?
Can I come in?
Yeah,
Yes,
please,
sir.
please
Please,
go ahead.
please.
I hope I'm audible.
Yes,
Just
please.
a follow-up question to Dr. Gupta ji. Of course, the international valuation standards are doing a lot of research and coming out with various other asset classes and prescribing standards. Should we not follow suit when it comes to maybe it could be ICAI, RVO or ICSI RVO? I think somewhere we are falling a step behind. That's
I
my
understand, sir. So Valuation Bill 2017, Clause 18 talks about Indian national valuation standards. It also has a provision for constitution of a committee. It also specifically mentions constitution of that committee as to who all would be the members of that committee. And so far as the information is available in the public domain, that committee got constituted a few years back, and probably they have also prepared draft of some of the valuation standards, but these are somewhere lying in the bureaucracy channel. I'm not aware for the time being, but nothing has yet come through.
I
So
fully
far as
agree
the
with
efforts
you.
that we had, so far as the efforts of individual RVOs are concerned, whether chartered accountants or cost, we have a valuation standards board in ICMEI RVO. But the point is, we develop those standards, and if it is not universally accepted at the national level, I mean, the whole effort goes waste kind of thing. It will be a futile effort. So there has to be a directive coming from the government to create these valuation standards either through that committee, which is still operational and standing kind of thing, or they can devise some way by which they say all RVOs should get together, talk to each other, develop some kind of standards. Then only the whole effort is going to fructify and is likely to be fruitful. Otherwise, one RVO doing some exercise, not getting acknowledgement in the market for that matter, it doesn't really make sense. As of now, Institute of Chartered Accountants of India have come out with their own standard. But as of now, out of 5,500 registered valuers that we have in the marketplace, only the members who are members of ICAI RBO are mandated to follow those standards. Other 4,500 registered valuers are following IBS. So that's where I would like to stop.
Yeah, correct. I agree with you completely. The reason why it struck me as very important was because you said that many IPs and professionals involved in insolvency matters often miss the intangible component of valuation, and which you very rightly said that it normally constitutes about 70 or 80% of the total valuation where it involves a CIRP or liquidation. Now, many professionals could miss that. So it attains importance that we need to incorporate a separate specialization, either as a separate examination or part of SFO. I think so.
Absolutely, sir. Absolutely. Absolutely.
Thank you, sir. Thank you. Obliged.
Mr. Gupta, there are 2-3 more questions
Yes,
which
sir.
are,
Yes,
which are like valued vis-a-vis the insolvency professionals. So the first thing which comes to our mind is, and most of them are IPs here, I think coming from you because you have served in both capacities
That's okay,
as the MD of the IP also, and then of course in the RVO. The main question is that what should be the role of an IP in valuation? Like supposing a valuer has given a valuation report. Now, is it the duty of the RP to examine it deeply or should it accept it on a face value? That's the big question which is in everyone's mind.
I know, not codified anywhere and possibly also cannot be codified. But IP being the process manager for the entire CIRP process that's run under the code, he appoints the registered valuer, of course, in consultation with the COC, fixation of fee, everything is done. But taking valuation report given by RB just on the face value, not questioning, not asking question, not going through the report, is also not what is expected from an RB. That's why you would have noticed that ICMI RBO is offering a lot of professional development programs almost every week, which are focused on developing competencies of IPs in the domain of valuation. We are not saying you become valuation professional, but at the same time, you should at least be able to develop capability, ability to question, ask some questions, maybe layman questions kind of thing. Once a valuation report is generated, presented to you by RV, थोड़ा कुछ basic कुछ question पूछ के, you will get to know how deeply the work has been done by the RV. And if apparently you think that something hasn't been considered, you can definitely give suggestion to RV to include those particular aspects also. That's going to hugely improve the quality of the valuation that we're getting in the market.
So therefore, what you are saying is the takeaway is that they should not be taken on face value.
No, sir,
So
not
the
at all.
RPs must examine them, apply their own
Absolutely.
mind, because ultimately they are responsible and they are answerable.
Absolutely.
Okay.
Absolutely.
I think that's a
And
great
with same
point.
analogy, I also do training program for various bankers. I also tell the bankers, once there is a valuation report given to you by a valuation professional, don't take it on the face of it. I mean, you should be able to ask intelligent questions. Just get a glance of what the report is all about, and then only accept that. Don't take it just because on a face value kind of.
Now, there is one more aspect, sir, which is hanging on the minds of most of the IPs, is relating to the confidentiality of this report. Now, initially, in the IP regulations, IBBI mentioned that it should be confidential, cannot be shared with anyone. But later
Yes,
on,
sir.
how they have amended the IP
Yes, sir.
regulation that the methodology. Now, I'm coming to a very specific point,
Yeah.
sir. They say the methodology must be explained to the COC members, even by the valuer or something like that. Now, that is one part. Now, the question again, which is in the mind of all IPs, that once the valuation report comes, should it be shared with the COC or only the methodology before the coming of the valuation report? Now,
No,
this is
no, no.
something.
Earlier, the provision was that the valuation report can be shared with the members of COC after obtaining a undertaking of confidentiality from them.
Potentiality, yes,
But
yes.
subsequently, by way of change in regulation, IBBI has now allowed the report to be shared, and also RB has to now make a presentation before COC,
Correct,
specifically with regard to methodology approaches being followed.
correct.
So this is what the regulation stands as of today,
Yeah,
and this is how we have to work on.
yeah, naturally, we'll have to follow
I will have to follow on
guidelines.
that.
Yeah,
So
naturally, we really appreciate that. I think, friends, almost all our questions are covered. If you
thank you,
still
sir.
have a
Thank you.
question, if you still have any question,
Anytime, let's connect offline, whatever you can share my contact details with all the participants. Any question that they may have, they can connect with me any point of
or
time. Thank you.
anyone wants to ask anything, so I think we have an opportunity. Let's catch him. Of course, I know he has been throughout the day. He was in some lecture.
No,
Of course, he would be willing to go as early as possible. But
no,
anyhow,
I still have to continue my session here.
Acha, continue. Okay. Then we'll
Thank
not
you so
hold
much,
you.
sir.
Then
Thank you.
just wait for 2 more minutes. Over to you, Tina, for the other formalities. Very quickly, sir.
Sir, 1 minute.
Thank you. Yes,
Sir,
sir, please.
Yes, sir.
Yeah.
sir, I have got a small question to Dr. Reska
Yes,
Gupta.
sir. Yes, sir.
Namaste, sir.
Namaste.
I would like to know the status of evaluation bill when it is likely to be passed by the parliament.
Nobody really knows anything about that, sir, including me. If some of you have better information, kindly also educate me on that.
Nobody can comment, sir,
Yes,
when it will be
about that.
passed.
We need an astrologer, sorry.
I don't know, sir.
All right. Over to you, Tina, please.
And
Yes,
my
yes.
mobile number in the chat box. Yeah, thank you.
Yeah. He's already
Thank
mentioned.
you. Thank you, Gupta sir, for sharing your mobile number and your knowledge with us. Now, I would request Ashish Makhija sir to express gratitude on behalf of IPNet and offer a moment to our chief guest.
Okay, thank you. I think it's a very warm and heartfelt thank to our chief guest of the day, Dr. S.K. Gupta, Managing Director, ICMA RVO, for actually taking time and gracing this seminar with his presence and sharing very invaluable insights on valuation of intangible assets. I think this was one of the subject which was bothering most of the RPs.
Right.
And I think a lot of things have been, clarified, his expertise and a thought-provoking address probably has enriched our understanding of this critical topic. Of course, it will be followed by one of our learned speakers who is already there. And on behalf of IPNet, sir, and all participants here and our team members, we extend our deepest gratitude for taking the time to be with us today and guiding us with your profound knowledge. Thank you once
Thank you so
again
much, sir.
for your invaluable contribution, for making this session absolutely insightful, sir.
Thank you
On
so
behalf
much.
of the IPNet, sir, we are showing you a memento on the screen. We request you to accept it virtually. We'll send you the hard copy later on.
Sure. Thank you so much, sir. Thank you. Thank you so much.
Please accept
Thank
it.
you, IPNet. Thank you, Makija, sir.
Thank you, sir. Thank you. Over to you, Tina ji, for further proceedings now. Thank you, sir.
Thank you, sir. Now I request Mr. Vivek Chirania to introduce the lead speaker of the webinar, Mr. Vikas Goyal.
Thank you, Tina. Mr. Vikas Goyal is a seasoned professional with nearly 16 years of diverse experience in industry and consulting, having worked with Pricewaterhouse, EY, ICA, and Jax Research across India and Canada. Currently, he leads OmniFin Solutions Private Limited and OmniFin Valuation Services OPC Private Limited, India, specializing in valuation, transaction advisory, and strategic consulting. He is a chartered accountant, chartered financial analyst, registered valuer from IBBI, and also got a certificate in financial modeling from NSE, National Stock Exchange. Apart from this, he is also a MS Finance, MBA in HR Management, and done PG, BM from IIM, Kolkata. His key expertise are valuation, transaction advisory regarding mergers, acquisitions, fundraising, and strategic consulting, and accounting standards, IFRS, Ind AS, and US GAAP. Some of his achievements: he was awarded CA Business Leader Under 40 in 2023 by ICAI and CNBC TV18. He has authored multiple books on valuation published by Bloomsbury. He is a trainer and speaker at renowned institutes and multinational firms. I request Mr. Goyal to address the August gathering. Thank you.
Thank you so much, Vivek ji. Thank you so much, Ashish ji, for inviting me. Rajiv Bhaiya, he's the one who sort of connected me here. So very, sincere thank you, gratitude for inviting me over. Of course, I attended some part of Dr. Gupta's session, and I had to sort of move from one place to another because there was a network issue. So of course I missed some part of it, but very humbled to be here. And I see it's a huge gathering on Saturday evening. So the topic that I'm going to talk about is intangible assets, and specifically we'll talk about intangible assets in the context of IBC. So I'm going to quickly share my screen. If you can confirm, you can see the screen.
Yes, sir.
Yeah. Okay. Right. So when we talk about, of course, I do not consider myself very learned in the IBC space. We do very limited work, but on the valuation space, of course, we do a lot of work. And one of the things that I have been talking about for a while now is the importance of intangible assets, even in the IBC space, right? So we'll talk about what is an intangible asset, right? And if you look at it from a regulatory standpoint, it is basically an identifiable non-monetary asset without any physical substance. So whenever we talk about the word intangible, we think of words like, okay, let's keep it a little interactive, right? Instead of me saying everything, why don't we use the chat window and keep it slightly interactive? Meanwhile, how much time do I have? Do I have an hour or more or less to cover?
You can take almost an hour, and then of course we leave some window for question and answers. And if you are making it interactive, then you can take questions in between also. So it's up to you.
All right. So I'll keep 1 hour as a ballpark duration,
Absolutely.
right? So whenever we think of the word, and please feel free to keep writing things in the chat window, right? I will keep more. Periodically I'm going to look at the chat window and see if there are any comments or questions, and then of course we'll see whatever we can take up at the end. Okay. So whenever we think of the word intangible, we think of words like brand, we think of words like goodwill, right? There could be trademarks, there could be copyrights. and patents, right? These are some of the common intangible words that we can think of. Can you talk about some, let's talk about what are some of the other intangibles that you might have heard about, right? So let's say I've talked about brand, I've talked about goodwill, there's trademarks, there's copyrights, there's patents, right? 5 common intangibles are there, but are there other intangibles as well? What comes to your mind? Let's
Loss,
use the chat window.
loss.
Let's be a little interactive.
It
Do you
could
consider loss also as an asset because it is a tax saving tool?
So it doesn't fit into the definition of an intangible asset, but we'll talk about loss. That's a very interesting thing. I saw that in the chat window,
because
right?
it could
We'll
be
probably take this towards the end, but it's not necessarily an intangible that way, right? So customer data, workforce. Ashish sir, you were saying something?
it could be mining rights, right to collect tolls. So those could be.
Yes, yes, of course. Yeah,
Forests.
mining rights. Forests, yes. So now forest is how is that going to be an intangible, right? I mean, that's basically land. So that's very tangible, correct? Development rights, yes, that's an intangible. Websites, playwrights, intangibles. Number of beds, rooms is not an intangible again, right? You can see the bed, you can see the room. Brand goodwill, I've already spoken about. So let's look at some of the other intangibles. So some of the common interesting intangibles that I already see in the chat window is number of customers is or customer data, right? I also see workforce. I see customer list. So again, that's customer data. Websites, yes. I mean, that's an intangible we all can very easily think of. Development rights or mining rights, yes, these are rights. Brand goodwill, we are aware of it. Lease rights, yes, there's a full-fledged specific standard on lease rights. Knowledge, intellect of KMP, right? So what I want all of us to keep in mind whenever we are talking about intangible from this point onward is let's look at the condition for an intangible, the definition of an intangible, because of course, whatever we do, we have to do it within the framework of a regulation. So it says that it is an identifiable non-monetary asset without a physical substance. So all the examples that we heard about would probably fit into except forest or bed, right? But intangible assets, these are basically long-lived assets. These are used in the production of goods and services, do not have a physical substance. They also represent competitive advantages. These could be developed or these could be acquired, right? And again, like I said, we can talk about copyrights, patents, and so on. Now, here's a couple of data points for you, right? I don't know how many of you would be familiar with this, but I have the snapshot, right? Or a small extract from the balance sheet of Info Edge India. Does anyone know what is Info Edge famous for? What is it commonly known as? What does this company do, Info Edge India?
Naukri.com.
Naukri.com. Yes, Info Edge India is Naukri.com. Do you know the price earning multiples of I know it is not into insolvency. We will get into insolvency very soon. We will get into insolvency. I'm not hoping Info Edge, but I'm saying let's look at this, right? Do you know what is the price multiple at which Info Edge trades at the moment? The P multiple of Info Edge trades at more than 200x, 235x is what I last saw, right? 235 times the profit. Just imagine, and we're still not calling it an expensive stock. So all of us, we are into valuation, we are into business assessments. We understand that a very high PE multiple will represent an overvaluation or it will represent a very high growth, right? So 235x. Now let's look at the balance sheet of InfoEdge, right? This is a small extract from InfoEdge, and it says that there's an ERP software, and the book gross value is this much, net value is 0.01. This is in INR million. Okay. Then there's other software license, there's brand, there's technology platform. So see, this is another intangible that we are talking about. We're talking about customer contracts and relationships. This is 33 million. Technology platform is 2.236 million, that is 23.6 crores. Then see, very interesting is the content. What does this mean? What is this content? Right? And this content is 21.7 crore, 217 million rupees. All of these and then there's non-compete. There was a broker network, so it is already amortized, so therefore the value is 0, but the life was 5 years, right? So these are intangibles which are recorded in today's companies, and the total intangible value is 896. In addition to it, now see, they recognize goodwill separately, right? And I'm sure, does anyone know why is goodwill recorded separately and not under intangible? I'm sure all of you can unmute yourself as well, right? So why is goodwill recorded separately and not as a total intangible?
It is acquired. It has acquired some other
It is
company.
it is acquired, and then goodwill is required to be shown separately under
To be
Ind
written off.
AS requirements. Yeah, under Ind AS requirements, goodwill is required to be shown separately, and goodwill can only appear in my books if it is acquired. I can never have internally generated goodwill. So the goodwill value is 3699 million or 370 odd crores, right? In addition to it, the company has investments in Zomato and PB Fintech and other investments are there. So the investment in Zomato itself is at a value of 21844 crores, right? So therefore, of course, this investment in Zomato will not feature into the PE multiple of Info Edge, right? Because that's an investment, that's a non-operating asset. But what the point that I'm trying to highlight here is that the intangibles and investments as a percentage of total asset is 79%, right? That is the balance sheet of Info Edge. Almost 80% of the balance sheet is consisting of two things, intangibles and investments, right? Now, this is how today's companies are operating. And this is not alone. Let's go to Zomato's balance sheet, right? Zomato again has recorded software and website as intangibles. Then there's trademarks, there is brand. Now see, how is Zomato recording this brand as an intangible? Is it Zomato's brand? Is it Zomato's brand?
Yes.
No, it cannot be Zomato's brand, sir, right?
But-
Because internally generated brand cannot be recorded in the balance sheet.
Sorry, sir. Amalgam acquired.
Acquired brand, right? So this would be probably Zomato when it is taking over some of the other companies, right? As part of the purchase price allocation, they have to recognize brand. So this is some other company's brand, not Zomato's brand.
Yes, sir.
Right? But customer contract and relationships, distribution network, technology platform, again, content, restaurant listing platform. And the reason why I have shown gross book value as well is because when I see some of these figures as zero, there was a gross value, right? Only because it is amortized that this figure is zero right now. Okay. And then again, it has also got goodwill. And this goodwill is 4717. The original goodwill value was 5060.
Oh, Baba, yeah.
Right? 500. And this is crores, by the way. This is crores. This is not million. I have just recorded the same figure as it is reported in the company's book. So 5060 crores of goodwill. And once again, then it has got another investments as well. So you see investments and intangibles as a percentage of total assets in case of Zomato itself is also 73.3%, right? So almost 3/4 of the balance sheet is consisting of intangibles and investments. So I hope that this is good enough for me to talk about the importance of intangibles in today's books or in today's businesses, right? But these are good businesses. These are running businesses, right? These are not these businesses have not gone into insolvency, and I hope they don't go into insolvency anytime soon. But let's talk about IBC. In terms of IBC, I'm not too much of a regulations person, but I thought let's try to get some of the definitions. So it says property. This includes money, goods, actionable claims, land, and every description of property situated in India or outside India, and every description of interest. Now, here's the important part. Description of interest including present or future or vested or contingent interest arising out of or incidental to property, which means it is including references to intangibles as well, right? Properties includes intangibles even in case of IBC. These are implied, but do we have precedents, right? I mean, in a lot of my conversations with IPs, and I'm not an insolvency professional, in a lot of my conversations with IPs, I hear a mixed response. We hear on one hand that how do we record intangibles under CIRP process? How is it possible? The values would have been eroded completely, etc., etc. So do we have precedents, right? Let's see. So Net for India Limited, right? NCLT addressed the fraudulent assignment of corporate debtors trademark during the insolvency process, right? So during the insolvency process, the company's trademark was assigned to somebody else. The tribunal declared that such transactions are null and void, emphasizing the importance of preserving intangible assets like trademarks during insolvency proceedings. So a lot of times, right? And trademarks is a very, very common intangible that you will find in businesses. Yes or no? Right? Now, one is having a trademark, right? Omnifin, for example, my company, right? We have a trademark on this. So one is having a trademark and second is the valuation of the trademark. But at a minimum, one has to recognize that yes, there is a trademark that is available, correct? And is there a difference between trademark and brand? Yes, there's a difference between trademark and brand. Is there a difference between brand and goodwill? Yes, there's a difference between trademark is different, brand is different, goodwill is different. But then does it mean that we can record all of these together, right? That's a question we will try to address. Okay, that's a question we will definitely try to address. So we have one incidence, Net for India, where NCLT declared the assignment of trademark as null and void because it wanted to protect the trademark. ASL Limited, right? Insolvency of ASL proceedings brought the attention of the treatment of spectrum licenses, right? So some of you were talking about licenses. Of course, this is a very, very important, intangible, right? So NCLT held that while licenses can be transferred as intangible assets under the IBC in ordinary circumstances, the same cannot be permitted if it contravenes the specific statutory provisions or terms of the license. Now, that's a very important part, right? This is a very important part. And this part is something that we will also discuss when we are going into recognition of intangibles, right? There's a condition, there's a reason why this was said, right? We will briefly address that. Okay. Third, we have a case from Kolkata, right? I am from Kolkata. So we have a case from Kolkata where the development rights held by Avni Towers Private Limited, right, over a 10-acre property constituted assets under the IBC, therefore being subject to inclusion in the information memorandum. So Supreme Court of India affirmed that development rights held by a corporate debtor will qualify as property under section 3 subsection 27 of the IBC, right? So it is also confirmed that, and Supreme Court judgment says that development rights will qualify as a property and it can be used as intangible. So that's a common intangible that we discussed when we spoke of what are some of the intangibles, right? Another case, the NCLAT addressed whether spectrum licenses could be treated as assets in the insolvency proceedings. Yes. So, so again, we've talked about spectrum licenses. These are intangibles. One more case, NCLT Kolkata bench allowed the distribution of unsold intangible assets, specifically book debts, right? So it is talking about unsold intangible assets like book debts among stakeholders under the regulation 38 of the liquidation proceeds, right? And again underscores the importance of intangible assets. Okay. So any question at this point? Why content is valued so high? Sir, we'll have to get into that, right? At the moment, let's not talk about the amount of it. Right now, the focus is only on the value of it. I mean, the recognition of it. We'll come into the amount as and when we can. Okay. Last example of intangibles under IBC is Shakti Bhog Foods. Again, it talked about the ownership of intellectual property rights, particularly the valuable Shakti Bhog trademark. Once again, there is a trademark, right? This case underscores the significance of brand valuation and complexities involved in the determining ownership. Okay. And the court also ordered that the COC could consider the trademark as an asset of Shakti Bhog and could proceed to valuation. So again, I think enough examples for us to understand that yes, there is a possibility of including intangibles under the IBC proceedings as well, right? Let's take a small pause and see if there are any questions. Does anyone have any question or a comment or a suggestion or an experience, right? I'll take quick pauses and we'll go into that. No? Okay. Okay.
I got a small doubt.
Sure,
Say,
sir.
some type of intellectual property has been borrowed for a fees. And in case the amount is pending, the main payment is pending, then in case, can it be taken as a asset or should it be a liability?
Sir, I buy a house, right? And against the house, I have a loan. Now, I have not paid the entire amount of the house. Is there an asset or a liability or both an asset and a liability, right?
It will be both.
So the intangible will be recorded based on the contractual rights that we have. Correct? So as long as the contractual right gives me the right of the intangible, and we'll go into the slide where we talk about the recognition criteria. So as long as those criteria is fulfilled, you record that as an asset. Against that asset, there may be a corresponding liability, right? That may be there.
Okay.
Okay. Now it is, and specifically, and let me address this from the point of insolvency as well. In case there is a situation, and let me guess what you might be saying is that, Vikash, I was recording something as an intangible in my books. The amount has not been paid, and the person to whom I'm supposed to pay that amount is not a claimant, right? So then in that case, should I get the full right of the intangible? In those cases, no. I mean, you may not have the recognition criteria fulfillment for that intangible, and therefore it might not be recorded as an intangible, right? That is a possibility, but we'll look at it from a transaction perspective. Does that answer your question, sir? Yeah. Yes. Thank you, sir. So there's a full-fledged standard, right, under Ind AS, and we take cues from Ind AS when we look at intangible assets, right? So Ind AS 38 requires an entity to recognize an intangible asset when purchased or self-created. So please note that Ind AS 38 conditionally allows us to recognize intangibles which are internally generated or self-created. Classic examples would be research and development assets, internally generated technology, right, formula, etc. But there is a condition, two conditions. It is probable that the future economic benefits that are attributable to the assets will flow to the entity. Again, the future economic benefits that are attributable to the asset. You should be able to identify that this benefit is coming from this asset. Second, the cost of the asset can be measured reliably. So these two conditions are very important before something can be recognized as an intangible asset. There is more. Okay. So in case the intangible asset does not meet the above two criteria, Ind AS requires that the expenses on this asset to be recognized as an expense when it is incurred. So this part is not relevant from the IBC perspective. Okay. But at least from a recognition perspective, these are important references that we can take, we should take. Okay. Further, it is also saying that, and this is the important part, right? This is the key part where we should be able to identify whether we can recognize something as an intangible or not. That the intangible asset is identifiable if it is either separable, that is, it is capable of being separated or divided from the entity, and sold, transferred, licensed, rented, or exchanged either individually or together with a related contract, identifiable asset or liability, regardless of whether the entity intends to do so. Now, see, this is a long sentence, right? But let's understand what it is trying to do. It is saying that I can record something as an intangible only if it is separable, meaning I can sell that intangible. I can transfer that intangible either individually or along with a related contract. I should be able to transfer it, right? Now think about it. We have already discussed two cases, two examples in our short duration already. We have discussed two cases where the separable criteria may not have been fulfilled. What are those? The first example was goodwill. Think about it. Can you separate the goodwill of the company from the company? Can you separate the goodwill of the company from the company?
No.
You cannot separate the goodwill of the company from the company, right? You can separate brand, but you cannot separate goodwill, because goodwill in its general parlance, from our understanding, includes the culture of the organization, the teams within the organization, the contracts within the organization, the profit earning capacity, everything put together. All the goodness of the company is integrated into goodwill. Can you separate goodwill? The answer is you cannot. And that's why Ind AS requires goodwill to be recorded separately. There is a separate standard which deals with intangible, which is Ind AS 38. Goodwill is not included in Ind AS 38. Goodwill is recorded based on Ind AS 103, business combination. The second reason why separability is important is when we spoke about this example. Yeah. Here, what did we say? That And the company law and NCLT is saying that while licenses can be transferred as an intangible under IBC in the ordinary circumstance, the same cannot be permitted if it contravenes specific statutory provisions or terms of the license. Right? Now think about it. Let me give you an example. Okay, let me give you an example. So we have, and this is just academic, okay, hypothetical academic example. We know that about a couple of decades, 1.5 decade back, the Ambani brothers got separated. Yes, let's have this conversation. We remember that the Ambani brothers got separated, right? Mukesh Ambani and Anil Ambani's family got separated and they divided the Ambani estate into the two brothers. Yes or no? Yes. One of the important businesses that stayed with Anil Ambani was the telecom business, right? You remember the Reliance Industries was the company that had changed the telecom scene in India. It literally transformed the telecom landscape in India. Why? Because of that CDMA mobile that Reliance had. Now, when the assets were divided, Anil Ambani got the telecom business. Where is that telecom business today? It doesn't exist today. But let's understand what happened as part of that estate division. As part of the estate division, the two brothers had non-compete agreements, meaning that the businesses that were kept by Anil Ambani Group were not something that Mukesh Ambani's group could enter into. Right? So Mukesh Ambani Group could not enter into the telecom business for about 10 years. And therefore, this was a non-compete agreement. So is this non-compete an intangible asset?
No.
Yes. Why
Yes,
not?
it is asset.
No.
It is an intangible asset, right? And we have seen an intangible asset is non-compete is an example of an intangible asset in one of the companies.
But
See,
how can it be transferred to somebody else?
we'll come to that, sir. Yes, yes. I know you've got the essence of where I'm going, but generally speaking, there is an agreement between two groups where one group is saying that the other group cannot get into this group because Mukesh Ambani's group also knew things about technology around telecom, correct? But the essence, we did not find non-compete as an intangible in the books of Anil Ambani Group, probably because, and I'm using the word probably because I'm not aware of that transaction. I don't have that agreement with me. Probably because this non-compete could not be sold by Anil Ambani Group to somebody else. It did not meet the separability criteria, right? But there are agreements in which the separability criteria can be fulfilled, and therefore this is an example where non-compete can be recognized. In case of Anil Ambani Group, we don't believe that this non-compete agreement could have been transferred to anybody. Okay. So the separability criteria, we have spoken about 2-3 things. A, we spoke about spectrum license, we discussed about non-compete agreement, and we've discussed about goodwill. Are we good? Any question? Any question? No?
Look at this valuation of intangible assets.
Yes.
The Ind AS will recognize as a cost incurred, just as we said in the previous statement.
No,
Cost
sir.
incurred.
Not necessary, sir.
For valuation, when it comes, we go with the IVS. So, is there a difference between IVS and when it recognized as an in case of intangible asset?
Absolutely, sir. So Ind AS is not talking about how do we value the intangible.
Okay.
Ind AS is only saying that you will recognize the intangible if the cost can be measured reliably. But the value of the intangible will be valued based on IVS or whatever valuation standards we are following. Yes.
Okay. Measurement is
Can I
different.
ask a question, sir?
Please, sir. Yes.
What about research and development expenses, which are normally charged off by small companies? I don't mean big pharmaceutical companies, but very small companies which have a turnover of, say, 200 crores. They charge off R&D expenses, although it constitutes about 10% of their total expenses. Is there any specific way of dealing with this?
Yes,
or
sir.
Instead of charging it
Yes.
off, can we spin off that
No, sir.
into
So
a
there is a
separate
specific
subsidiary?
way of dealing with this, right? I'll tell you
Yeah.
the generalized part of it, and then of course we can
Yes,
go
sir.
into the details of the standard. So research and
Appreciate.
development, sorry.
I said, please go ahead.
So research and development expenses are dealt with in a very specific manner. We divide the research phase and the development phase. Research phase is where you are experimenting. You don't know about the outcome of the research. So therefore, whatever you are spending towards the experiment is charged to the P&L. Okay. The moment you've completed a trial run and now
Yes.
your trial runs are successful, you know that now you can commercially develop this product, right? So again, look at the criteria. It is saying that it is probable that the future economic benefits will flow to the entity from this asset. So now you have completed the research, you have got to a product where this product is now productive. The money will come to the company from this product. Now you just have to develop this product, meaning you have to package it well, you have to give it a good design. So the development part can be capitalized as an intangible. The development expense can be capitalized. The research expense is charged to the P&L.
I
Okay.
understand. Just as a follow-up, there are so many companies that I know of which actually charge off their entire R&D expenses on a year-to-year basis.
Uh-huh.
Is that okay, or should we spin that off into a separate subsidiary of the parent company? Is that will that give any added benefits to such a company which has been in existence for say 20 plus years and have definitely built goodwill?
So, sir, I think so. Of course, this question takes us outside of the scope of the discussion,
No,
but
I
I'll
don't
still do
know. I
this.
don't know. Maybe
No,
you
no, it's
should
okay, sir.
decide. I just
It's okay.
asked.
So, from a valuation standpoint, there is a lot of premium that is given to companies which do research. So, let's say if I am looking at a pharmaceutical company as an example, right? And this company is supposed to create drugs, and the company is spending heavily into research, I will give it a premium even if the company has not come out with a new drug in the last 5 years or 7 years or whatever, right? So if the mere fact that the company is spending into research gives a premium to the company because something new will come up. It's still CWIP at the end of the day. From a valuation standpoint, so the answers will differ between accounting and valuation, right? Accounting requirement is research
I
is
think
capitalized, development is charged to research is expensed and development is capitalized. From a valuation standpoint, the entire R&D may be capitalized. Valuation perspective, I'm saying, right?
How do
So
we go? Don't we need an accounting standard for that?
no, we don't. I mean, why is
To
the
take care of
valuation?
these companies?
Sorry?
To take care of such companies, don't we need an accounting standard which specifies
So now we are
what
getting
is
into policy,
capital
sir.
and what is
So
okay?
from insolvency to business, business to strategy, strategy to policy,
I
right?
understand. But
Sir, see,
this is a
so
relevant
accounting
question, I believe.
standards, no, sir, in my opinion, we don't need a separate accounting standard for this because the current accounting standards under Ind AS appropriately captures this. Because see, when we
Okay.
are preparing the financial statements, financial statements have got multiple stakeholders, right? Financial statement stakeholders includes employees, includes governments, includes investors, includes lenders, and all of them. So therefore, there is a
Yes.
multi-purpose utility of the financial statement, and therefore, research amount being expense and development amount being capitalized, in my personal view, is an appropriate classification. From a valuation standpoint, if I'm doing valuation from an M&A perspective versus a retail investor perspective, my treatment of R&D will change, right? So
That is
valuation
where
is going
I'm
to be
coming from.
contextual. Yeah.
Because many small companies have this problem.
So it's not a problem, sir.
Classifying
It is their
R&D.
accounting issue. So as long as the accountants and
How do
auditors
you
are appropriately treating it, it is not a
how do you
problem in my opinion.
encash? Sorry, how do you encash research and development expenditure which has gone at least 10% of your total revenues over a 20-year period? Is there some way of capturing that and converting that into valuation proposition?
Sir, so again, I think how and why do we need to capture that is the question, right? So yesterday the CA final exams results came out. Now there are students who have been writing the exams for the last 7 terms. That's that's R&D for them, right? That's CWIP for them. So for some of the cases, the encashment will not happen unless the result is positive. For the others, some of them will drop out and still get a good job. So I think it's the same analogy that we are talking about here, right?
Okay, I got what you're saying. Thank you.
Right. Okay. So,
Because I
yes.
got one query.
Yes,
Can the
sir.
value of the intangible be more than the amount spent?
Of course, sir. Yes, it can be more. Why
Then how
not?
is it accounted?
It is not it. Okay, so it will be
Or
accounted
is it
when
through
you are acquiring.
revaluation?
Okay, I get your point, sir. So internally generated. So one is the valuation, which is the fair value, and one is the transactional value, right? So if you so let's say if I'm talking about R&D as an internally generated intangible. So internally generated intangibles will not be recorded in the books at fair value. So if you have an R&D, your capitalization would be only to the extent of the amount spent. It will not be more than that. Brand, for example, you would have spent a lot of money, but your capitalization will never be there. So it will not be more than this. So from a recording perspective, if you are asking me, then no, right? But from a valuation perspective, if you ask me, of course, yes, right? So my book value of brand is 0, but my fair value of brand can be huge, enormous. Now, in an acquisition, I will record a brand value based on how much I have paid to acquire that brand, right? So today, if I acquire company X Limited and X brand becomes my brand, so then of course the value in my books is what I have paid. It is not more than what
Yes.
I would have paid. So yeah, it will again change based on two situations. Okay.
Thank you.
Yeah. So some of the common intangibles that we come across are related to marketing, where it could be trademark, domain names, non-compete agreements, like we said. Related to contracts could be licensing, royalty agreements, license agreements, right? Plays, books, pictures. So yesterday my new book has come out. So again, if I have the copyrights of it, that is an intangible for me, right? Related to customers could be customer list, right? Customer contracts, customer relationships, and so on. Technology-based intangible assets could be patents, software, databases, secret formula, processes. So these are some of the common intangibles that we will find. Now, if I quickly just go back to the info edge, right? Now, if what is the market cap of this company? Can anyone quickly just check the market cap of Info Edge India today? Just quickly tell me what's the market cap of Info Edge India?
1,11,000 crores.
1,11,000 crores.
Yes.
Right? Out of this 1,11,000 crore, the total value of intangibles is 24,896 crores, 28,496 crores. Yes or no? We see that here. This is in millions, so this is the crores value. Yes. Yeah. Now, if you see, even then, the value of the company is very high, right? Yes or no? Even if I subtract the intangibles that's recorded in the books and the investments, the value of the company is still very high, correct? Yes or no? Where is this value coming from? That's an intangible which is not recorded in the books of InfoEdge, right? Because what is the key intangible? What is the key value driver for a company like InfoEdge India? Any idea? InfoEdge India organically owns database of more than 3 crore individuals in India. Yes, more than 3 crore individuals. And these 3 crore individuals are qualified individuals, educated individuals. And it has got their names, addresses, email addresses, phone numbers, qualification, marks, last experience, current salary, expected salary, all of that. Correct? Now that's an intangible which is not recorded in these balance sheets. Please note that it's an internally generated intangible which is not here. So here that intangible will classify as a customer list, and that customer list for InfoEdge is internally generated and therefore will not find a place in the balance sheet. So whatever intangibles that we see on InfoEdge balance sheet is actually acquired intangible or intangible for which the cost is easily measurable, right? ERP software, it paid 2 crores or whatever, 20 lakhs for ERP software, that's there. It paid another 20 crores for other software license, that's there. But customer list is something that is not recorded in the books of InfoEdge. So I think that part we should be very clear about. Are we okay? Yes. Are we going okay? Is this making sense? Because I have this August gathering in this house Saturday evening, it should be worth your time.
It is
Are we
pretty
doing
good.
okay?
Yes,
Pretty
sir.
good.
Thank you, sir. Thank you. So Now, how do we value some of the intangibles, right? So let's say if I quickly run through some of the valuation approaches, okay? So I'm going to skip a couple of slides. Intangibles, we can value using income approach, cost approach, market approach. Okay, those are the three approaches. Income approach, we all know, is a present value of the future cash flows. These are some of the common methods which are used in valuation of intangibles. Okay, one is relief from royalty method, excess earning method. Then there's premium profit method. Greenfield distributor method are two not so commonly used method. And then there's economic value added. Now, before I go into this, right, let's understand a brief strategy around intangible asset recognition under the IBC. Okay. One thing we should be very, and I am talking about this because it's not there on the slide. One thing that we should be very clear about is that intangibles, especially intangibles such as brands, right, are very prone to very quick erosion, right? So for anybody who ever told me that, Vikash, how do I record a brand value for a company which has gone into CIRP? Okay. Is that a wrong proposition? Or can we really record brand value for a company which has gone into CIRP? Let's have that quick discussion here before we move on. Right? Is it appropriate to recognize brand value of a company which has gone into CIRP? If yes, how? If no, why not? Right? Let's have that conversation. Any views on this?
If it has got takers, then we can recognize it, like Nokia or some other brands which have already incurring losses or into bankruptcy, like Jet Airways or Kingfisher. And still, though they are into bankruptcy, they have got values. That's why there are takers for Jet Airways or similar companies.
So how would you establish that? And it's a very right line of thought, sir. I mean, it is. I am completely aligned to it, right? How would we establish that brand value? It cannot be just a whimsical point of view, right? There has to be a logic around it, or there has to be a substantiation around it. Because if let's say we were talking about Jet Airways as a brand, I don't know whether that brand actually got valued and it got traded or not. But let's say if it was actually valuable, how would you establish that brand valuation for Jet Airways? कैसे apply करते? How would we get to that number?
No idea.
No idea, right? So first of all, we have to
Customer
understand.
acquisition.
Sorry.
Customer acquisition is one of the key factor when we can value. So if going typically by the valuation things, so with or without method, that could be one of the this thing.
Yeah. So arguably you are saying that, Vikash, if I launched a new if I launched a new airline today versus I revived Jet Airways, right?
Yeah.
Jet Airways would help me get more revenue as compared to a new airline. Is that right?
Certainly. Definitely.
Yeah. So if I'm able to establish that, right, with some arguments, and then I can put those arguments, I can quantify those arguments and say that there's going to be a gestation period for a new brand of airline to get
Right.
as compared to Jet Airways. Therefore, I can establish Jet Airways as a brand and then revive it. But having said that, Jet Airways still failed, right? So why wouldn't somebody say that if it had a brand value, then why would Jet Airways not perform on its own as a next point?
So I think the reason for failure were quite different. So here we are talking about the brand. So brand has a perception. So
Yep.
so we can take an example in a corporate where people at the top always prefer jet over the other airlines. Traveling from the other airlines, and in comparison to that, except that maybe Air India or any other premier airline. So I think that perception will again count if again we revive Jet Airways as a brand in comparison to a new brand, and getting customer acquisition through that brand. Obviously that will make a difference, and we can compare the the passengers or the guests which we can take on board under the umbrella of a new brand, and populating Jet Airways as the revival brand. So
Absolutely.
definitely that would be a difference.
Absolutely. So absolutely right, sir. And then in addition to it, And because I am assuming that most of the audience here are IP professional, insolvency professionals as well, we also go into the reasons for failure of this company. Wherever we are able to establish that the reason for failure was not business itself, but the management or the management strategies or the approaches or a fraudulent activity, right? The brand itself was not tainted. It is the management which did not run this brand well. That's where you can establish a brand value. Having said that, it will always be looked at from a pinch of salt, right? So the default stand is, and it is mentioned in the standards as well, the default stand is that if the company has gone into CIRP, meaning the business has not performed well, therefore one of the first intangibles to erode from the company value is brand. One of the first intangibles to erode is brand. Now, in our example, if tomorrow we hear that Kingfisher Airlines is coming back, will our perception change when I say that Kingfisher Airlines is coming back and Vijay Mallya is bringing it back versus Kingfisher Airlines is coming back and maybe Tata Group is bringing it back? Will our perception of Kingfisher brand change?
It will
Yes.
definitely.
Definitely.
With Tata's, yes. With Tata's, yes.
Yes. Or let's say anybody else, somebody who doesn't have as as negative a reputation as the Malyas, correct? So again, the brand valuation will also change based on those contexts. So once again, before we start thinking of recognizing something as a brand, we have to understand that by default, a brand value will erode if the company has gone into CIRP. However, in certain circumstances, we can always argue that the brand can still be revived depending on why the brand actually failed. Okay. So that is one important thing that we must keep in mind. On this note, there are some methods to recognize intangibles. Let's talk about how do we value some of those, right? So of course, we can't go into too many examples, but briefly, I'll explain the context in terms of how these intangibles can be valued, right? So one is relief from royalty method. What this method typically says is that if, let's say I am owning a brand, if I did not own a brand and I had to earn the same amount of revenue and somebody else owned this brand, how much royalty did I have to pay or would I have to pay to the owner of the brand, right? Therefore, by having my own brand, I have saved some royalty. What is the present value of that royalty? That is what relief from royalty method is. It is saying that by having the brand myself and not renting the brand, what is the relief from royalty that I have got, right? Now, once you understand this context, you know it is very easy to value, right? You will have to, the most important, the most typical thing or the biggest challenge in relief from royalty method is calculating the notional royalty rates. So what you do is you forecast the financial data of the company like the revenue, the tax rates and the growth. You calculate the notional royalty rates by analyzing what the similar companies charge for similar assets in the licensing agreements. So in case the company is into a business which has franchising agreements, then your life is very easy, right? You know the franchise rates or royalty rates. You apply those royalty rates and forecast the company's value. Estimate the expected life of the intangible. So again, this is also very important, right? I have already shown you in the earlier two examples of InfoAgen and Zomato that these intangibles have an expected life. And this expected life includes for brands, right? It includes for licenses. It includes for almost all kinds of intangible except for goodwill, which is treated separately, right? So you estimate the expected life of the intangible. Only during this period, you will be able to get a premium, okay? Then you apply the royalty rate as a percentage of the forecasted revenue. Basically, you say how much royalty you have saved and the present value of this royalty is the value of the brand or value of that, basically the brand. You will apply the relief from royalty method to brand, or you could apply the relief from royalty method to copyrights. Let's say what is the copyright rate. So basically anything which has a licensing arrangement, which has a potential licensing arrangement, you can calculate the value of that intangible, right? Now, of course, I'm inviting questions. Can this be applied in the CIRP context? Can we do this? How can we value this, or how can we address this under the CIRP context?
Sir, am I audible?
Yes, sir.
So my question is basically not related to CIRP, but in normal scenario when you mostly do PPA assignments in days 103, right? So basically, the question particularly is related to the longevity of the brand, yeah, the life of the brand, right?
Yep.
So there we make an assumption that 10-year is the maximum life which we can take as per India's 103, right?
Yep.
So they mentioned the logic also in the particular Indias also, but practically what happens is which is seen in real life also. Brand has its value as it becomes old. The longer the period the brand is established itself, right? So when you are doing a fair valuation for a brand, right? What is the expected life should we presume? Is there any thumb rule or any guiding factors to take
Sir,
this?
there are no thumb rules, sir, but of course it changes from industry to industry. I have done valuation of a company which is 125 years old, and it's a, let's say it's a Switzerland watch brand which is already 125-year old. Now they are asking me to do a brand valuation in a context. Now, on what basis will I say that your brand valuation cannot be more than 3 years or 5 years or 10 years? They will say I have a 125-year-old history, correct? So yes, those are difficult questions to address, but it changes from industry to industry. What we also have to understand is how does the company derive its brand value? Is the brand value significantly dependent on the advertisement expense, for example? If yes, so then you have to look at the advertisement expense. So if the advertisement amount falls down, the brand valuation will definitely fall down, right? So you see the trend of advertisement, right? Because for most of these brands which are heavily dependent on advertisements, the customer recall values or the recall period is actually going down. We all remember Nirma advertisements or Onida advertisements or Amul advertisements from our times, but how often do we remember a new brand which came across just 3 years ago, did intensive marketing, but has not done any marketing in the last 3 months? We would forget that, right? So that's a long memory, short memory kind of a thing. So you will see how is the brand generating its value in the first place? Is advertisement an important factor? One. Second, we also look at the competitive advantage, right? Now we go by simple economics. So economics 101, it told us that competitive advantage will not be available in the long run. Everything converges towards normal profit. So even if the brand is there, right? No one's saying that the brand is not there. But what is the value of the brand? That's the important question that we are trying to address. Correct? So so think of it, sir. I think and I think this example will probably help you understand this. Think of a Colgate advertisement or a Dove
Sir,
advertisement.
coming back, sorry to interrupt you,
Ah.
but in your case, when Swiss company, the watch company you valued, so what is the life you have taken in that case, if you can share?
Sir, I cannot share, but sometimes you also go
Roughly
by the
10 years,
regulation.
15 years, 5
Sir,
years.
5-7 years only, sir. Not more than that.
So we are
5-7
actually
years.
saying that his brand would last for 5 to 7 years.
No, sir. I'm not saying that the brand will last for 5-7 years. Let's understand.
Brand value would last for 5 to 7 years, is it?
No, sir. So the competitive advantage from that brand will last for 5-7 years only, because this is a Swiss brand which is entering into an Indian market. In the Indian market, what is the value of this brand and for how long will the company have a competitive advantage? Uska present value मुझे निकालना है. I am not saying the estimated life of the brand. I am not doing an accounting here. I am doing valuation, sir.
No, you are doing fair value. So longer the life, the more the value, right?
So just to add on,
No,
so
not
are
necessary, sir. Not
so
necessary.
just to add on,
Yes, sir,
just sorry.
if I do a PV for a 10 years projection, or if I do a PV for a 5-year projection, right? So the 10 years PV would be always be more than mathematically.
No, 100%. Okay. So let me address that point, sir. What I'm trying to say is so there are two things here. When I'm doing the valuation, what is the projected period that I'm taking? And second, what is the useful life that I'm recording in my books, correct? Over which I have to do the impairment or I have to do the amortization. These are two separate things. These are not necessarily the same things. When I'm looking at the projection, my projection is only dependent on the fact that for how many years will the company have a competitive advantage. The cash flows can continue, right? मेरे को कितने साल तक उसका competitive advantage मिलेगा? Let's say profit premium method, for example, हम लोग लगा रहे हैं अगर. So for how long will the company be able to command a higher profit margin, higher revenues as against a competitor?
So, but how did we zero down on 5 to 7 years competitive advantage?
So that's
Is there
so we
any?
are assuming that beyond this, the company's competitive advantage will not be significant. That's the assumption.
Is there
So,
any?
for example, if India is also telling us 10 years, right?
Mhm.
There is a basis on which the policymakers decided ki let's not have a brand value more than 10 years. In India, also income tax regulations require you maximum period of amortization for some of the intangibles.
That's a different thing. I mean, those
Ah.
statutes are, I mean, see, statutes can define anything. It's a
Correct.
law of the
So
land.
that's why I'm not going into the statute. I am saying that in our assessment, what we try to see is for how many years will the company have a competitive advantage against a competitor.
So is there any checklist or something to gauge the competitive advantage of the
Sir,
brand? Is there any
we have
mathematical
a
formula or
100-point
any
scoring mechanism. So
guideline?
internally at Omnifin, we have a 100-point scoring mechanism. So we look at 3 frameworks: legal, behavioral, and competitive. And then we have 5-point framework where we say, is brand contributing to lower cost of capital? Is brand contributing to lower customer acquisition cost? Is brand contributing to higher profits? Is brand contributing to lower attrition rate from an employee perspective? So we have an internal framework based on which we do a scoring. And based on that scoring, we decide कि हम लोगों को कितना premium इस पे assign करवाना है. So that's a comprehensive assessment of brand that we do when we do it.
Achha, thank you, sir. Just last thing, not related particularly to the same thing which we discussed. Just, I mean, because a lot of things are happening in renewable energy, and the solar space is quite hot. So, a lot of acquisitions are also happening. Suppose one company already in a renewable space acquire a controlling stake in another company, which is also so one project is there, solar project, live project, COD is there, PPA is also signed. So this I am particularly asking for India's 103 PPA, right? So if PPA assignment has to be done for this solar project, so their main is the PPA agreement, right? So the contractual agreement is the main intangible they have, right?
Yes.
So how to particularly value this particular intangible?
You cannot, sir. You cannot.
Sorry?
You cannot
I
value
think,
that
if I
separately
may.
because the PPA will not meet the separability criteria. Mostly, usually the PPA will not meet the separability criteria. Therefore, whatever value you'll have to calculate, it will be subsumed into goodwill only. Can the agreement, the purchase price agreement that the company has with the government or with the customer be transferred to somebody else? The answer is usually no, right? So therefore, you will not be able to recognize power purchase agreement as a separate intangible. I don't see that in any company's
No,
balance
but
sheet.
this agreement, obviously, I mean, uh,
So company की value में आएगा sir.
okay,
Separate
you are
intangible
saying
recognize करेंगे कि नहीं करेंगे that we have to see.
I
एक बार
think
हम
I
लोग
don't
आगे
know
बढ़ जाएं sir.
if I
Let's
may.
take this offline because we have other participants. So I just
Yeah.
don't want to sort of
Okay.
stick on one point. Okay. Yeah.
Okay. Thank you.
So
Thank you.
yes.
Just
So I
to
think.
clarify what our friend said,
Yes. Go ahead, sir.
just my opinion, I won't take more than 10 or 20 seconds.
Go ahead, sir. Go ahead. Yes.
Just to clarify, the Indian accounting standards don't specifically say that you can recognize goodwill beyond a certain point.
It doesn't say that you can recognize goodwill. Is that what you're saying?
Yeah.
I didn't understand this statement, sir. I'm sorry. So
Okay.
goodwill is purchase consideration minus fair value of the assets acquired. Whatever
Okay.
that balance is,
Goodwill,
if it is positive, that's goodwill.
it
That's
cannot
it.
be recognized.
Why can't it be recognized, sir? We have goodwill. अभी हमने देखा भी 2 examples. It can be
You are
recognized.
right, Vekashi.
It can be. Hello?
Yes. Sir, I think you're talking from an income tax perspective or what, sir? Because goodwill is not available as an income tax deduction since 2020
Yes.
now.
Yes.
So income tax
Exactly.
deduction will not be available for goodwill since 2020. But of course, you recognize in your books, no? So in fact, that's the other point I was
I'm not
coming.
very sure of that because the accounting standards say unless you make a purchase of a business unit, you can't recognize goodwill value in your books.
So
That is
that's
what I
about
was trying to
internally
say.
generated.
I may
Absolutely,
be
you're
wrong.
right,
I'm
sir.
not
So
very sure.
internally generated goodwill cannot be recognized in the books. Goodwill can be
As a
recognized
part of
only when
business
you have acquired
combination,
another
yes.
company. Hello?
Yeah, in short, only goodwill can be recognized only when you acquire some asset.
Absolutely. Yeah,
not
yeah. We've
otherwise.
discussed that. Yes, yes, yes. Internally generated goodwill cannot
Okay,
be
right. Thanks.
Yes.
Okay,
So
thanks.
I think the other point that I was talking about from a recognition perspective is, and I think this may be relevant for the IPs. What we have seen is, see, in the CIRP process, there are multiple stakeholders. One of the stakeholder is the resolution applicant also, right? The company which is acquiring, which is putting in a plan to acquire the company which is under distress. So a lot of time what happens is when we are advising this company to put in a resolution application that this is the amount that I will pay, that is where the intangible valuation becomes a very critical factor. Because what is happening, because I'm usually doing the valuation. See, if we are talking about iconic brands like Jet Airways, Kingfisher, etc., it's a given that everybody knows that there is a brand value. But what most people miss out on is the other intangibles as well, right? So let's say technology, a classic example. So let me give you a scenario, right? So there is a company which is, let's say, a steel company or a metal company. This company has gone into CIRP, right? Now, if this company has gone into CIRP, there is another company which will go and bid to acquire the assets, basically put in a resolution application. How will I decide how much money should I pay to acquire this company, right? How should I decide that? In my calculation, because I also have to have some calculation, right? That minimum I have to pay this, maximum I can go up to this. My bid has to be within this range. How do I decide कि मेरे को कितने पैसे देना? How much money should I pay? That's where when I am doing the assessment, I am trying to see that and I think when the first question came in was, is loss an intangible asset? So let me address that point here. So yes, definitely. When I'm putting in a resolution application, I'm saying that if I am a profit-making company and I'm putting in a resolution for a loss-making company, what is the loss carry forward that will be available to me, right? And I put that in my resolution plan that all the losses that this company has will be available to me as a deduction. So there is no questions asked, deduction for loss carry forward. But is that an intangible? Can we recognize that as an intangible? The answer is no. But I have a clear tax benefit out there. So if the company has 400 crores of loss, that 400 crores of loss is available to me as a deduction over multiple years, and therefore I will recognize direct deferred tax asset while I'm recognizing when I'm putting in while I'm doing the purchase price allocation. But that loss becomes a factor. The other thing that becomes a very important factor is the intangible. So the company may have a technology, the company may have workforce, the company may have customer list, the company may have contracts, right? I look at all of these intangibles as an outsider, right? Once I have access to whatever data the insolvency professional is providing to me, I look at that. I have to do an internal assessment saying that can I recognize this as an intangible after I have acquired this company, right? So if I'm able to do that, let's say I'm able to recognize 100 crores of technology as an intangible after I'm acquiring it, right? This 100 crores of technology will be available to me for amortization over multiple years after the acquisition is done. So that amortization additionally becomes beneficial for me after the acquisition. Are you getting my point, sir? Right? So this
Yes, amortization is one thing.
Yep.
Amortization is one thing, but suppose I am to bid for a business which is in CIRP, which has obviously a lot of intangible assets. So how do I account for that? I would still be interested in acquiring or making a bid
Of course.
for
Sir, what is there in the balance sheet that you can definitely acquire.
CIRP company. I think many resolution applicants do that. And they look at intangible assets, what might be in the fray for them in the future.
Absolutely. So what is there in the balance sheet that is anyways going to come, right? That is not a challenge at all. I am saying what is not there on the balance sheet, that becomes an important asset for me, which I have seen in my experience, a lot of IPs are missing out on, right? So therefore,
absolutely, I agree.
Yeah. So let's say there is a CD whose loss was 1,000 crore. Okay. 1,000 crore loss or whatever, 1,000 crores of debt rather. We say claims, right? Now the resolution applicant has put in a resolution of, let's say, 250 crores. So he pays 250 crores, but against this 250 crores, he will get, let's say, assets, whatever the asset value is. So What IPs are normally doing is they are comparing 250 crores of tangible assets, which might include
Yes,
land building,
exactly.
technology, land building, plant and machinery, and receivables and cash and so on and so forth. But in addition to it, I have to see that there is a loss carry forward as well, right? And there is intangible as well. So these intangible and
Yes.
loss carry forward are basically important values, I mean, important assets for the resolution applicant. That's where they make a lot of gain, right? Whereas the lenders of this corporate debtor have actually let go of the company at pennies to a dollar, right? So I think that's the whole purpose of having this discussion on intangible. Okay, so relief from royalty is one method.
Thank
Like I
you.
said, that if you have any intangible which is available for licensing, you look at the notional royalty rates. Based on the royalty rates, we can see what is the royalty that we have saved, and the value can be calculated. Okay, I have a small example. If you want, I can leave this example with you and maybe just move into the conceptual understanding of intangible. Is that okay? Or do you want me to actually go through a numerical example? Can we just
Please
move
go
to
ahead,
the
sir.
next, yeah, let the next concept. Okay. So this is there. I mean, you can take a look. The second is multi-period excess earning method. This is the most common method which is applicable in case of purchase price allocation, whether it is technology, whether it is, I mean, most of the intangibles are actually recognized using multi-period excess earning method. Fairly complicated, I would say. But what it basically says is, and this is where I think when I was having this discussion with Mr. Manish, right? For how many years will you be able to earn an excess return over a comparable asset, right? Or over a comparable intangible is what this method says, right? So it says that you obtain the projections of the entity or the combined asset over the remaining useful life of the intangible, analyze the projections and an underlying assumption, assess the reasonableness of the cash flow. So basically, you assess the reasonableness of the future cash flows. The important deduction here is the contributory asset charge. I don't know how many of you are familiar with this concept, but this is an important concept which is required. Basically, if I'm talking about a brand, can the brand function on its own? No, right? I mean, if for my brand to be able to generate an excess return, it will have revenue, it will generate excess revenue for me, it will generate excess profit margins for me. But in the process of doing that, it will consume certain working capital as well, right? So if Ashirwad Atta is selling more atta than an ordinary atta, if Amul butter is selling more butter than an ordinary butter, so we are talking about Amul brand or Ashirwad brand, but this Amul is also consuming certain working capital, right? It will need more inventory, it will have more working capital requirements. It will also consume more fixed assets. So what is the return on fixed asset that the brand should also contribute to is a charge that is deducted here, right? So you reduce the contributory asset charge or economic rents attributable to working capital or to fixed asset in addition to EBIT. So basically, you calculate the operating profit from that brand or from that intangible. You also reduce the working capital and capex contribution, contributory asset charge, and then you get the incremental after-tax cash flows, and you discount that using the multi-period excess earning method. Okay. Once again, I have a small example here, which we can take a look at. So here we are saying that let's say the working capital amount is this much. The fixed asset is 8 lakhs. So normalized earnings for the coming year, that's a projected earning, it's 2 lakh 20. So this is the important part. The required return for fixed capital and working capital is addressed, right? And you have the growth rate in excess earnings, discounted of 14%, you get to the value. Now here we are assuming that there is an infinite life here, but only for academic purposes. In reality, we need to consider a finite life for intangibles. Okay, just for academic, I was sort of quickly trying to create an example. So we've created it this way. Now, this is the most intuitive method of understanding intangibles, the most intuitive method. I mean, and think about it, right? Think of any consumer brand. Think of a Colgate, think of a Dove soap, think of Surf Excel, right? Any consumer brand. Think of an advertisement. It says that it is better than an ordinary toothpaste. It is better than an ordinary soap. It is better than an ordinary detergent. right? It is better than an ordinary wheat flour. Any product brand or consumer brand you take, it compares itself against an ordinary product, right? That is how the brand value is assessed. Basically, if I was manufacturing tea, right, and I sold that tea, white labeled, Khulla Chai, and I sell the same tea in a Tata tea packaging, right? What will be the difference in my cash flows? So it is with or without method. So a brand is going to contribute to a higher revenue or a higher volume. I mean, basically higher price or a higher volume or both, and consequently a higher margin, right? So this premium profit method or with and without method will basically compare all the business assets, including the intangible, and all the assets except the intangible to be valued, right? You take the comparison, the difference is the value of that intangible. And it could be not only brand, it could be a non-compete agreement, it could be brand, it could be technology, it could be a lot of other things, right? It's a simple capital budgeting exercise and a very, very intuitive way of calculating the value of an intangible, right? Any questions on this? I see some questions here. In CIRP, if the companies are not going concern, then how can this method be applied? Again, so we will see. Rashmi, can you unmute yourself? Can we talk, ma'am?
Yes, dear.
Yes. So if the companies are not undergoing concern, then some of the brands will not be addressed. For example, you will not be able to recognize a brand. You may not be able to recognize intangibles, which are very, like I said, right? So some intangibles are very prone to erosion the moment a company goes bad. Some intangibles are not so, right? For example, a technology. So or research and development expenditure, for example, right? We come across a lot of professionals who are like scientists or software developers, and they were working on some product, right? And now they have run out of energy, but they have reached the stage, right? Can that be developed into something else? So again, it is always going to be based on your business understanding. If it can be developed into something else, you will recognize that as an intangible. You will
So
value that.
basically, in a company where there are R&D expenses, that can be taken as a source for. But like if the company is not operating, the how can the projections be made? Because in all your examples, the method you have given how to calculate the intangible is that profitable method.
No, I have a
taking
couple of
royalty.
more
हाँ.
which are cost based.
Those are revenue
But
based. So in these examples, we cannot the question of
so
forecasting
you
the
can still do
projections will
that,
come to
Rashmi.
the RP. No,
No,
that will come to the that will still come on the RP because again the operations are suspended. And if the RP is not able to project the forecast the projections, how is the valuer going to
is RP going to do the valuation? No.
no, but who is going to give you the projections?
So that's a very interesting question, Rashmi, right? Now, as a valuer, there is no regulation that says that the projection has to be given by somebody else,
So
right?
can the valuer himself makes projections on the
A
basis of
valuer should be, so again, I know that's a very controversial point, but yes, the valuer should be able to, right? The valuer should be able to do that.
but for then the base things as like growth chart, growth rate, these all
I
these
agree. I
factors.
know. I know it's a difficult exercise. It's not happening very common, right? I totally agree with you. So I think the whole valuation profession will still have to grow. It is, we are still some years away from a situation where the valuer will be able to do it or the IP will be able to do it. We are still evolving as a profession. But yes, the whole point is that if there is an intangible, we know that there is an intangible. Should we ignore that intangible because there's nobody who's willing to take a claim on who is going to make the projection? No, you can always have a conservative valuation as well, right? So yeah, I know that's a very controversial point. Let's
Another thing, like you said, ki losses can be a part of your intangibles.
No, I'm not saying that. Sorry. I'm saying that
Carry forward
losses
losses.
are considered by the resolution applicant while bidding for the company.
Yes.
It is not an intangible that a valuer will recognize. It is not an intangible that you can carry in your books. I did not say that. And thanks for bringing that up for clarification. It's not an intangible asset at all. I'm saying two things which are normally considered by resolution applicants beyond what is there in the balance sheet. Yes.
Hello.
Yes, sir.
Hello.
Yes, sir. Yes, Dr. Arora. Go ahead, sir.
Yes, sir. Yes, sir. What I was saying is, I work as a plant and machinery valuer, but then we have an entity where we have a CA and land and building valuation also. But when we work together, some things are extra covered than what we do normally as a plant and machinery valuer. So when we are, working as an entity, we give a better result, keeping
Yes.
into view the brand value and these things,
Yes, sir.
intangible assets also, and their life also. This is what I wanted to convey.
No, you're right, sir. Of course. So we also work as an entity valuer, and sometimes
Sir,
that
I
gives us
also I
benefits.
am also one of the IP as well as plant and machinery registered valuer,
Yes, Mr. Ji.
and
Yes.
I feel as what my previous presider had conveyed, I had also the same view, because what happens, you have got a documentary implications regarding product process developmental implications compared to somebody who want to take over, which is ready to use in all respect, which is just a technology driven implications, which are also supposed to be recognized in the valuation implications while you make the CIRB projection. That is my submission to you, sir.
Yes, sir. Yes. I totally agree, sir. Yes.
Thank you
Thank
very
you.
much.
Okay, sir. So I'll quickly run through because I know I'm running out of time here, right? Conceptually, so we said that you can have free cash flows with the non-compete in place and without the non-compete in place, right? I want to, I'll skip the greenfield and the distributor method because these are very specific and contextual. This may not be applied when you are not operating as a going concern, right? Now, I think the last part, right, where we spoke about what if the company is not operating as a going concern, how do we recognize intangibles there on cost basis, right? So if I look at two examples, one example could be brand, the other example could be R&D, okay? The third could even be technology for that matter. In fact, yesterday we were discussing an engagement where there is a very clear accountability of how much money the company has spent on the R&D, right, for this intangible. Now, this intangible is going to meet the criteria of recognition, and just then the company has gone into CIRP, right? So you look at the cost which has been incurred. As long as you have data around the cost, you can always conservatively recognize the intangibles. The second thing, the second approach, especially for example, in case of brands, is that look at the amount of money that the company has spent on advertisement over the last 3, 4, 5, 6 years, right? If the company, and I briefly spoke to, I think, Manish ji when we were talking about some valuations around it. If you have that information, what we do is we know that the advertisement expense is charged to the P&L. But if I know that this advertisement expense is, so let's say I spent 1,500, right? I spent 2,000, I spent 2,500, and I spent 3,000, okay, in the last 4 years as my advertisement. So now this amount would have gone into my P&L, correct? Absolutely, this amount has gone into my P&L. But what I judge as a valuer or as a business professional or as an IP is what is the benefit of this, which is available in the subsequent years. So let's say I assume that 4 years is the benefit that I will get. For every amount of money that I spent during a year, the benefit is available for 4 years. And this is year 1, 2, 3, 4, right? This is -1, -2, -3, -4. We are sitting in the year 0. So that means this 3,000 is now valued as 0. In this 2,500, what we'll take 1/3 of this, correct? Because 2/3 is elapsed, 1/3 is left. For this, we will take, so 4 years, right? So we will take 2/4. That is available. Half of it is elapsed, half of it is available. And here we will take whatever, 3/4, right? That's the amount of money that is still available for me. So I multiply 15 into 3/4 plus 2,000 into 2/4 plus 2,500 into, I think, 1/3. So 1/3 is left, right? That is the value of intangible that is available in my books today, right? Which I can record, which I can assess as fair value. This is, of course, a conservative value because I don't know the future aspect of it, but this is based on the conservative historical number that we can capture. Are we okay on this? Rashmi, does this address a concern that you had or the question that you have?
Yes. But
Yes.
it is most likely in the valuers whom we appoint. How does they account for this?
Of course, right? So I think, yeah. So like I said, right, we have to mature. So and this is not my discovery, right? This is a globally accepted practice. There are valuers across the world who are using this approach to recognize an intangible. Like I said, accepting that an intangible exists is the first step. So right now, let us first acknowledge that there is an intangible. In fact, that's why in all the examples of the NCLT that I gave, right, there were two examples where we spoke of the word trademark. Now, let me complete my session on this note, and then, of course, if there is any question, we'll take it. A trademark and a brand cannot have two separate identities. Trademark is the visual identity of a company, and brand is the beneficiation or the monetization of that visual identity. So I cannot have trademark and brand both. But if I have a trademark with me, the trademark value could be as low as 20,000 rupees. Okay. It can be as low because you can get a trademark. The cost of getting a trademark could be just 20,000 rupees. So that is my beginning. And now if I see that no, this trademark can yield some benefit to an average person, to a market participant, that's when we start adding premium to this trademark, that becomes the brand value. Trademark will not have a huge premium normally. So trademark and brand will be interlinked to each other.
Like once the trademark is taken, the owner of the company, how it, मतलब Amazon में कितना उसने किया, मीडिया में उसने कितना उसको बैठाया, उसका advertisement
So
किया,
that will
all
be
those
the premium on
those
trademark.
will
So
be the
we'll call
premium.
brand. Brand will include the trademark. You will not say trademark separate, brand separate. Okay. So I think that's my bit. Yes, open to questions, sir.
Sir, what do you think the profession today is limited to land building, plant machinery, S&F valuer? How you propose a valuer who can implication, particularly with reference to revival under the CIRP companies, having these repercussion related to
So your voice is
Sorry.
cracking.
Yes, you're not
asset
audible. Voice is breaking, I believe.
valuation.
So, Mr. Mistry, your voice was cracking. I
Hello.
couldn't hear you properly, sir.
Sorry,
but
what I want to say today, we have got a three profession only under the CIRP regulation.
Yes.
That is land building, plant machinery, and the SNF.
Yes.
Now, do you think that there should be an expert also in terms of intangible asset valuation while the CIRP process are engaged and the projections are prepared for the applicant for whom there will be an appropriate justified mode for revival?
Sir, I think we don't need a separate class of valuer who will do the intangible valuation only. You might find it a little biased, so I would like to avoid the controversy, but normally securities financial assets valuers can do a lot of intangibles valuation. However, in a lot of cases, for example, technology is a classic example, R&D is a classic example,
I'm coming, sir.
where we need the help of let's say an engineer or a specialist who understands the business aspect. So for example, sir, that problem is there in case of inventory valuation also, right? So inventory again, time and again, it has been established. So there we take the help of an expert, sir, wherever required.
I appreciate your point, and let me share with you today in the whole Gujarat, I do the enforcement valuation as GST department for recoveries. So there it is a different cup of tea. Though of course I am an engineer, IP, IBBI, and CBTT registered valuer as well as company secretary also. So
right. So
here
we
is
take the help of
a
experts
different
accordingly, sir.
experience and exposure which I had. So it is highly comfortable. And let me share with you, I did a valuation of 150 crore worth supari valuation for the recoveries for the GST department. So it is a question of what type of job you get it.
Absolutely.
And
Absolutely.
what type of exposure you get it and what purpose for which you get it, the valuation.
Correct.
So valuation is not just limited for CIRP or X or acquisition or takeover and other things. There are a lot many other various stakeholders who are involved. Particularly here in this case was the revenue. The revenue authority, I was being safeguarded to the High Court. Then I justified the implications related to that. I made the micrometer and measurement, and I show this what is the A class, B class, C class, D class with sampling and other implications also. So it's a question of exposure, what type of work one has to do it. So what I suggest to the group that in case this group wants any kind of technological implications help, I am available, and I am also IP as well as the registered valuer. Of course, I have not done SNF valuation. Of course, training is completed by me.
Thank you, Mistry ji. Thank you.
Thank you,
We
sir.
will definitely
Thank you.
hold one seminar to listen to you. Any questions from the audience now? Or should we close and
I
conclude?
have a question. I have a question, and I hope I'm audible.
Yes, you are audible, please.
Yeah, sir, in general, can there be a scenario where if the ex-management of the CD, which is admitted under CIRP, claim that there are intangible assets, but which are not visible on the balance sheet? So this is a real scenario where an IA has been filed by the ex-CMD. Resolution plan has already been approved by COC, and then the ex-CMD feels that somehow the valuation has been done ignoring the intangible assets. But as far as the balance sheet, the last audited balance sheet is concerned, it is available as of 2021. 2021 is the last audited balance sheet, wherein we have seen that the intangible assets are shown as zero. And upon looking at the previous balance sheets, so the intangible assets value was appearing only way back in the year 11-12. After that, continuously, it has been written off and it has been shown at zero continuously for all these years. So it is a defunct unit, and it is a hybrid seed manufacturing company. So the opposite side claims that there are certain plant varieties which haven't been shown, though they haven't been shown in the balance sheet, they still have value which has been missed out in the valuation exercise, and hence the value, whatever is being brought in by the resolution applicant, is far less than what's the real value is what they claim. Can you comment on this, sir?
Sir, so I can comment on the earlier intangible that was there. So again, I cannot comment on the process whether it can be reopened. In my logical view, yeah, of course it can be reopened. But if there was an intangible in the books, let's say in 2010-11, and now we are sitting in 2024, right? Normally, the intangibles would not have, normally, again, we don't know what kind of intangibles we are talking about. Normally, the intangibles will not have such a huge life, right?
Okay,
Most of the intangibles will have a lifespan of 5, 7, 8 years. But of course, if the business sense says, and I always am a strong believer of what the business sense says, sir. So if the business sense says that, yes, even today there is an intangible which is there on record. I mean, it may not be on record, but the business contains certain intangible that should be factored in. But can procedurally it can be done? I'm sorry, sir. I'm not an expert on that, so I may not be able to comment on that. But I'm sure there are very senior professionals out here who can probably comment on it.
Okay, then thank you to the participants for asking so many questions, and the questions are just coming and coming. So we have to organize one more session, I believe. I am sorry to the participants. Can you please drop in text box whatever are your questions? The same will be sent to Mr. Vikas. He may deal it accordingly.
Can you just repeat the valuation based on advertisement expenses?
Ma'am, Tina ma'am, I'll take just 1 minute to explain this, right?
Okay, please go ahead.
So Pradeep ji, what I was referring to is, so let's say you look at the last 4 years advertisement expense every year, you will find that in the P&L, right?
Yes.
Your business sense should say that what is the life of this advertisement spend. So if I believe that my advertisement spend benefit is available over a 4-year period, so what I'm going to do is, if 4th year, whatever at 4 years from now, right, 2020, let's say, whatever advertisement was there, no benefit available today. 2021, whatever advertisement was there, 3/4 is eroded, 1/4 is left. Right? Whatever happened in 2022, let's say, so again, half is available. 2023, 3/4 is available. And 2024, the entire amount is available. So basically, that's an assessment. I think that's how we'll do it. So simply unamortized portion based on the life of the advertisement spent. That's how we'll take it, sir.
We'll request Mr. Vikasji to share his slides also, because participants are very much interested in so many questions. So please drop in chat box and may directly contact Mr. Vikas. Now I'm there to make an announcement of IPNet North webinar on 4th February 2024. That is on information utility. And there will be a lot of things that will be considered with respect to Form C filings, errors, and many things. So I request all the participants to participate on 4th January 2025. So everyone please participate and let us all learn from information utility personals how to fill in Form C and other details. Now I will request Ms. Rashmi
Madam,
Chacharia.
I'll just,
just
I'll
one
just
minute, I wanted to interfere. 4th January,
Yes.
I think there is one seminar at a conference at Kerala, and
Yes.
there Dr. Ashish Makija sir is also coming.
Yes, yes.
Are we still going to have this at 4 p.m. there?
Mr. Tripathi, let me add here. At the end of the day, the show must go on, right?
Okay, sir.
And we have called the managing director of the information utility. He will be there as a chief guest. He'll give us a keynote address, and their team will actually present on information utility. So how to access, because IPs are typically not aware how to access and what are the facilities there. So coming from horse's mouth, it will be a fantastic webinar. Whether I'm there or not, sir, show must go on.
Thank you, sir. Thank you, sir.
Sir, our president has prepared us very well to take care of the things. So we will definitely try to take care that he will receive. Now switching on to Rashmi ma'am, Rashmi Chacharia. Madam, please take over for vote of thanks.
Tina. Thank you, Tina. Time is the essence of everything. Good evening, everyone. I'm Rashmi Chacharia, representing IPNet East, and it is a privilege to extend the vote of thanks today. I would like to express my sincere gratitude to IPNet for providing me with this opportunity. Today's event was much more than a webinar. And Mr. Vikas, you are just incredible, and lot of questions, and curiosity level was increasing for us IPs too. And first and foremost, I'll extend my heartfelt thanks to our Honorable Chief Guest, Dr. S.K. Gupta, who is the Managing Director of Registered Valuers Organization of the Institute of Cost Accountants of India. Sir, your presence has added immense value to this occasion, and your insightful words and vision have inspired all of us to think bigger and strive for excellence. Thank you, sir, for gracing with all your time and wisdom. I would also like to thank our President, Dr. Ashish Makhija. Sir, your relentless dedication and visionary leadership continue to make IPNet a platform of unparalleled importance. And you have been the mentor for all of us. And we believe that this learning knowledge and relearning knowledge will continue. Thank you, sir. And special note of thanks to our keynote speaker, Mr. Vikas Goyal, and our dedicated coordinator, Tina Saraswat. And a big congratulations to Speaker Vikas, as yesterday was the launch day of his new book, Valuation of Business Securities and Financial Assets. So your valuable insights and perspectives have enriched today's discussion, offering us new directions and understanding that will surely shape the valuation work of the future. Thank you for your commitment and sharing your vast knowledge with us. I would also like to extend my sincere appreciation to Transition and the technical support teams. You work tirelessly behind the scenes, ensuring that everything runs smoothly. Thank you. Thank you, everyone in the team. And finally, to everyone who participated today, your presence, enthusiasm, and active engagement have made this event truly remarkable. Together, we are building we are going to, we are building a huge remark, and we will be a community that will not only foster professional growth, but also drive innovation and collaboration in the insolvency professional across India. Thank you once again to all those who contributed, participated, and supported this remarkable initiative. Thank you, sir. Thank you, everyone.
I think the memento has to be presented to the speaker.
Thank you.
Okay, Vikas, thank you so much. And
Thank you so much, sir.
Congratulations on your book, which was released yesterday. I just came to know about it. I mean, many, many congratulations. And thank you so much for coming here. I think the physical memento will be sent to you by Rajiv. Okay.
Thank you so much, sir. It was an absolute pleasure, and really honored to be here. Thank you.
Pleasure. And wishing everyone, all IP participants and everyone who is there, wishing them a very, very happy new year, and also to Vikas Goyal and all my colleagues out here at IPNet. Thank you.